The zombie apocalypse is coming, but it's not at your front door, it's in your bank account. Zombie companies threaten to not only destroy your portfolio, but could trap the economy for decades. In this video, I'll explain zombie companies, show you what this means for stocks, and then reveal a list of zombie company stocks to avoid. We're talking the zombie stock market today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's talk money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, we can all breathe a huge sigh of relief that we've made it through that god-awful Hollywood love affair with zombie movies and can get back to what really matters, like vampire werewolf threesomes. But just when you thought it was safe to go back outside, a new kind of zombie outbreak has started, and this one is going right for your wallet. I'm talking about zombie companies, businesses not even earning enough to make their interest payments. And normally that creative destruction that's the hallmark of capitalism would put companies like this out of business. A company that can't compete or earn profits just should be shut down, and the workers and resources that it's using go to more profitable businesses. That's how capitalism works. It makes sure that those resources are best used in the best possible way. But that's not happening right now. The Fed has pumped over $4 trillion into the economy through different programs, but largely buying up the bonds of corporate America. And while it has kept us out of a depression, it has created the biggest debt bubble in history. The Federal Reserve, the central bank responsible for guiding our very monetary policy, is now investing in the debt of junk-rated companies with questionable financials at best. That $4 trillion money printing scheme has forced interest rates to zero and created the borrowing bonanza. March and April debt issues soared to $587 billion, with just the first half of 2020 recording more corporate debt issuance than 16 of the last 20 years total. And nation, I know all this financial mumbo-jumbo may not seem like it matters, but these kinds of things have consequences, and real consequences that will affect the economy, your job, and your finances for years to come. Now, those rock-bottom interest rates and that easy money is keeping companies from filing bankruptcy. It's a kind of financial life support because even with no earnings, they can still just borrow money to keep paying those costs and the interest on their debt. They borrow new debt to pay off the old. And in fact, we've seen this particular zombie movie before. Japan suffered through what's called the lost decade, though it really ended up being more like 2 decades, where economic growth dropped to zero. Wage growth was zero or even negative for many workers, and the stock market plunged 80% over the 13 years to 2003 and has never really recovered. Now, the US and even the global economy is facing its own lost decade, and the consequences don't look pretty. If interest rates do increase, companies are going to find it impossible to refinance, and a wave of bankruptcies is likely. That's actually the best scenario, though, because it would clear out a lot of these zombie companies and the stocks. The hit would be quick, it would be painful, but it would be over. Now, the other scenario, though, would be similar to Japan's experience: 20 or 30 years of 0% stock returns, negative wage growth, and a walking dead economy. Now, unfortunately, there is not a lot you can do to stop all this from happening, but you can protect your own investments by being able to recognize the worst of these zombie companies. And this means digging into a company's financial statements to find the ones on that monetary life support. Now, you do this by looking at the income statement, and I'll show you 3 examples here next. You want to look at the income statement and look for a company's operating earnings. Now, that's going to be about a quarter of the way down the report. Now, technically, most analysts are going to be looking for what's called EBITDA, or earnings before taxes, depreciation, and amortization, to compare this against the interest expense that the company owes. And you can use either here, that operating income or the EBITDA, but what you're looking for is whether it's negative or positive and the general trend. Now, besides these core earnings, you're also looking for the amount that the company is paying in that interest expense each quarter. A company with earnings too low to pay its dividends or reinvest is one thing, but one that can't even make enough to pay that interest payment, that's a walking corpse. Now, searching through those financial statements, most of these zombie companies right now are going to be concentrated in those hardest hit sectors during the pandemic. You've got a lot of oil companies here, and this is where a lot of the bankruptcies have already started, with that crash from $60 per barrel oil to negative prices last spring. You've also got a lot of the companies in travel, tourism, and entertainment. Now, not all of these companies are in danger of turning full-blown zombie, though. but the longer the pandemic lasts, the closer you're going to need to watch your portfolio. So now I want to show you 3 examples of zombie companies, and it's not that these specific stocks are doomed just yet, but they're definitely very high risk, and you need to know how to spot them. Our first zombie stock probably won't come as a surprise: $1 billion retailer Bed Bath & Beyond, ticker BBBY. Shares of the home furnishings retailer have been falling since 2013 with multiple turnaround attempts and hundreds of closed stores. A new CEO took over last November offering a new turnaround strategy, but plans got postponed on that coronavirus, and the company is now in survival mode. The company operates 1,500 locations across North America, many of which are in malls struggling to bring customers back. It's estimated to have about 10% of the U.S. market share for home furnishings, but that's falling each year as more sales go online. Now, the company does own a lot of smaller brands like Cost Plus and Bye Bye Baby that it can sell off quickly for some quick cash, but that's only going to help it for so long. Now, operating profits have been negative here for the last 5 straight quarters and will likely see losses in the second and third quarter of this year as well. With over $4 billion in debt and climbing, it's going to be a tough road to profitability in an environment that was already a nightmare for retailers. I know I'm going to piss off a lot of Atlanta fans here, but billion-dollar Liberty Braves Group, ticker BATRK, is next on our list. The publicly traded owner of the Atlanta Braves gets most of its revenue from ticket sales, concessions, and broadcasting rights, and that's going to be a pretty slim business for a while. Players reported a summer training camp on July 1st, with the season starting a few weeks after that, but teams will play just 60 games versus their usual 162, and teams are only going to play against others in the region. The league is leaving it up to each state whether fans can attend, but even if stadiums do allow people in, it's going to be at drastically low attendance, like 50% capacity. Now, shares have actually done pretty well here since that 2016 IPO, rising about 70% over the period to December 2019. But that limited revenue and $690 million in debt makes it tough to see any upside here. The company posted 6 of the last 10 quarters with negative operating earnings, and even the 4 positive quarters didn't leave much after paying interest on debt. If baseball isn't 100% back to normal for the 2021 season, and that might be a long shot, but if it isn't, this stock is going to strike out. Even mega cap companies can become zombies, and $105 billion Boeing, ticker BA, is no exception. Shares have been under pressure since February of last year, and they are now down 57% from the peak. The stock could get a sentiment boost late summer with that recertification of the 737 MAX plane, but it's not going to help much if airlines don't need those planes. American Airlines has already told the company that it won't take delivery of 17 planes if Boeing can't offer financing for the purchase. That's going to mean Boeing Capital is going to have to secure financing for that itself to make the deal. 3 of the last 4 quarters has seen Boeing operational profits slide well below interest payments. The company has reported a loss of $6.3 billion over the last year, plus the $860 million it's paid on the interest on that debt. And it's going to get worse before it gets better. Boeing borrowed a monstrous $25 billion in April on top of that $39 billion it already owed. That's going to bring interest payments to about $2 billion a year, and the problems for major airlines means Boeing isn't getting a lot of orders for at least the next few years. Another problem, though, is the amount of money it's going to cost to pay that interest and shrink the debt means Boeing isn't going to be able to reinvest much into plane development for years. Airbus already has 2 planes in development that have no competition at Boeing and could mean the European giant eats away at more market share. Now, before you say that the government would never let Boeing go under or file bankruptcy, just because a company files bankruptcy doesn't mean it stops operations. That's what bankruptcy is protection from creditors to still stay in operation. The aerospace giant could still operate even after it wipes out its shareholders. And even if this stock, the company, escapes bankruptcy, the shares could be dead money for years. Click on the video to the right for the 5 safest investments for your money. 5 investments ranked for returns and safety. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.